right, so welcome once again, everybody. So this is our weekly review at Proflex, and as we were discussing right before the call, so this has been one of the, I would say, most challenging in recent times. This is, I would say, correction which, it came because market was maybe a little too overconfident about the war, and as we always call the Trump taco trade, that it will get resolved fast. The promises of Trump saying that he doesn't go into wars, and now he's got stuck into a pretty long war. It looks like. So that's what market is reacting to right now. So let's walk through what's going on, what's the impact, and how do we make sense out of the data. So as I was saying before the call, it's very interesting right now what is happening. It's not just the market move, I know. So what is changed today in the chart you will see is that we usually look at daily chart and we zoom in. Today I'm going to look at a weekly chart here. This is the war, and we did discuss, if you remember, a few weeks that market was not dropping as hard as it should, based on a pretty big war US got into. And that is because everybody had this whole optimistic view. Everybody had this thing about Trump cares about the market. So and it's also the learnings, right? When you look at the weekly chart, you see that we have seen drops, big drops, not that we have not. 5% drops, 6% drops, and market recovering, making a V-shaped recovery. So what is happening right now? We have a 5 consecutive weeks of drop. First, it was slow. It as the V-shaped recovery did not pan out, it has accelerated in last 2 weeks. And again, it is mostly around the expectation changing on the war. There are concerns around the flip-flop which is happening from Trump and so on. But let's put that aside. Means we can always have opinions around it. But what is happening here is that market has actually dropped pretty significantly. I would say around 8 to 9%. Nasdaq has actually dropped 12% from the top. And as we were discussing, if you remember, last 2 weeks back, that Nasdaq was actually doing better, and it was not even making a new low. And last 2 weeks changed that, because now it's basically a secular downtrend, we can call it, across the board. Now it doesn't matter. This is what we call liquidation. This is what we call when markets are not rotating, when everything is dropping, like whether it is IWM, which is Russell 2000, whether it is, even though I think this week was interestingly, it ended better for the wider index. So this is a good sign that at least the wider indices are stabilizing. But on the other hand, as we say, that it has already dropped much harder earlier. So I won't call it as a positive, but it's just a observation here we can see on the chart. So what is really happening? What is happening is all the story, I think, much better understood from volatility. Now, for the volatility, of course, let's look at the daily chart, because it has a much interesting story to tell you on a day-to-day basis. So today, especially, so what is happening? Like you will see that every Friday, the VIX is spiking. It was never the case before, right? Means in old days, means only since the war it is happening. You will see if you go back in the normal period, even though the VIX was on the uptrend because of uncertainty, it always used to spike, within Wednesday, Thursday, middle of the week, and it used to, like, if you see it come down on Fridays, like almost every time you used to see volatility going down on the Friday. And that is because market used to look at the expiry. A lot of option expiry used to help it. What changed? What changed is the unknowns. As the war became more and more uncertain, every Friday, basically, you are saying that I don't know how the Monday is going to open. I don't know what is all the events can happen in these 48 or even 60 hours, because then when the market opens, it's almost like 2.5 days, and that is where the Fridays have become much worse. And especially today, when you're looking at the VIX of 31, 32, as we say in the finance world, that there is a simple rule of 16, where you say if you divide this by 2, that is the average move market is expecting for the SPX to have. So you're basically saying almost a 2% move per day. Now, what is the math of it? Like, if let's assume that, yes, size dropping, as it happened, last 2 days have been almost dropping like that. Like today, it was 1.7%. Yesterday, it was pretty high as well, almost similar. So what I'm saying is, market is now you have to expect the market is right now pricing in average drop for a longer period of time of this proportion. Now, it's not a rocket science to say that if you drop 2% per day, you will get to zero very fast. And everybody knows that it has to stop. So the question here is, where does it stop? How long the pain is there? And that's, I think, what, of course, we will figure out over the period of time, the news flow and so on. But at this time, what we are seeing is, yes, there's a breakdown. The market is giving you that premium. And the market is actually pricing it in. While when we saw the drops, like if you go back to the SPY, it's not that we did not drop earlier. We had huge drops at a lower volatility also, and that means market was not pricing it in. So this is the one part which it matters for people, especially if you are into the option trading and so on. It matters that market is actually paying the premium for the drop right now with the VIX being so high. The second part which I wanted to say is that it's not just because of the war, it's about the weekend uncertainty. Because even immediately last week, if you see, on a Monday, we had almost touched very, very low VIX after the week. Of course, there was some optimism around the end of the war. Trump had started giving statements around, the negotiations and so on. But in general, it kept on, even though market believed or not believing is a different question. But basically, what we are seeing here is this is becoming a wartime routine, that every Friday the VIX is elevated, and then once you see the news, of course, you are pricing the worst, and then the market calms down. So this is the last 2 weeks story, which I wanted to highlight. Now, this is where I think if you are part of our managed account, we just recently just sent a video, and we're going to talk about through the opportunities there. But you just need to be aware of the market environment. What is really happening here is that these are the times where if you react wrongly, like because market has to hedge way more on Fridays because of the unknowns, while the risk premium is way higher. So you have to be careful of not panicking on Fridays or the weekend moves, because these are nothing but the market makers and the risk, the hedge funds and so on. They are unsure of how to hold a position. So having said that, okay, where are we right now? Like where we are is the SPY is definitely broken down below the 200 moving average now. Conclusively, we are, as we discussed, we are like almost in the correction territory of 10%. We are in. I don't, as I have always said, I don't believe in this hardcore numbers of 10% and 20% of recession and all that, and because these things are just made up numbers. But overall, what I'm trying to highlight here is the markets are definitely oversold. Markets are panicking right now, assuming the worst. Now, the question is whether we can find a resolution. And we were always looking at the oil trade. I think oil is kind of topping out at 100, which is very surprising given the status of the war. I think it's right now it's the uncertainty about whether we are talking about boots on ground, whether we are talking about this ever resolving in 2 3 weeks versus 2 3 months or 6 months or 9 months. I think that's where market is uncertain. And I think if any of us, we try to guess or predict, that's not in our favor. What we can do is, and what we recommend is, look at the fundamentals. If this resolves, there is nothing, even the oil is not pricing that this can stay very high, because it's a very artificially localized problem where WTI is still low because there's enough capacity which US has. Brent is higher. And recently, I think you will see that even we discussed it on our WhatsApp group, that even the Dubai and the countries which are impacted by the blockage of Strait of Hormuz, they are also the premiums are reducing now. So there is this conflicting views in the market right now. One is on the escalation from whether this war will get escalated. On the other hand, the oil market is suggesting kind of intermediate ground right now. So all we can say right now is that ultimately the panic is much bigger, which is shown in the VIX, versus anything uniquely changing in the war scenario. And the panic doesn't stay high, as we discussed. Every Monday it comes down, or there are a lot of reasons it can come down. Mathematically, it cannot stay here because market cannot move 2% per day. It's a 2 to 3 sigma event. And I think that is where, but we are watching now that how does it get resolved. If you want to compare what happened last year in a trade war, it went way higher. So it's not that I'm not trying to suggest that this is the worst, right? There can be uncertainty, can be even higher, which happened during the trade war. But on the other hand, the higher it goes, faster it resolves. And that is exactly what everybody is waiting for, on which direction it resolves, and market accepts it at some point. So I think that's the overall story. I would say, again, there are no other catalysts. Till the earnings season doesn't come by end of this quarter, which is going to be almost 3 weeks from now or 4 weeks from now, when the actual earnings start rolling. So market is unfortunately waiting for the catalyst. This is what is happening. So I will be willing to take some questions here, and let's discuss, what people are thinking about. But overall, it's very simple, right? The idea here is that right now market is in very high panic mode. It's a fear is defining the stock price. We have discussed multiple times how the size of derivatives, size of mm, the leverage trading impacts short-term prices. Whether it was March 20th stability, because we had this whole option expiration where which helped us even during the war phase to not let the market drop. While since then, I think we are building up positions at a lower level. So be careful when you take conclusion. Like the market is, yes, it looks like panicking. It need not be a situation where this can resolve very fast, because when you have VIX so high, that means there is too much at stake for market makers, for the hedge funds to unroll. Like when the market goes in reverse, it also goes very fast, which we have seen whether it was last year in April timeframe when the Liberation Day happened or so on. But yes, I think whether it can stay high for a very long time means mathematically it cannot, as I said. Even let's say the worst case scenario of war escalating. First of all, now let's talk a little bit about geopolitics here. That the data on the ground is that even though Iran has been found to be more resilient than what US thought, but the number of missiles they are sending outside now has reduced. Those are objective facts. The number of factories they had, they are destroyed. So their capacity to fight has reduced. They are basically holding the Strait of Hormuz hostage, and there is this whole fear factor right now of US sending more troops and US trying to control that. Now, yes, that is uncertain. Yes, that can further create more panic in the market in short term, but nothing changes in the US economy on the ground other than uh, it will start pricing in the higher inflation. Now, higher inflation is the only risk which right now where the yields are going up, where there is a small risk of where we say that market will start pricing that in, and there is a discussion going around of rate increases. And that I think is one thing which will not be as I said, it cannot be a fear factor that gets adjusted. Even if you look at when actually we had a rate increase, which was one of the steepest in the market in 2022. That is a great template for us to review how the market fell. And at that time, we had a very similar drop where once it was confirmed, that was a 7 week drop back to back. And then market stabilized and bottomed out. So market is already front running a lot of that. So there are two possibilities here. One is that market realizes that the worst is not going to come. The second part is that market is already front running the worst case scenario right now. And I think that is what is one positive I can take out of this data when I compare this with 2022 data points and so on. So yeah, let's take a quick questions. What will be the VIX if we have boots on ground by Monday? I would say, and this is again speculation, but market is already, like as I said, 30 is very high. 30 means 2% drop every day or 2% move every day. Means 32. And means in either condition, would you say that other than the inflation factor and the oil remaining a little high, war has been usually stimulative? We have been a part of so many wars over the last 20, 30 years. We have not seen any negative impact of that on US markets for a very long term. So I'm not very concerned about any change in the war scenario, unless, of course, something big changes, like, let's say, hypothetically, I'm just guessing right now, like, coming, China says, and that, oh, we are going to support Iran in the war, and we are directly coming and supporting with our defense forces. Means, again, this is a very, very hypothetical case, right? When basically it blows up beyond what it is today. So I don't think that is going to be a huge difference in how market perceives it, and it's more about the weekend risk right now. Um, I see a comment about market seems to be overreacting, but the Brent price is topping off at 100. Is this a market trust that US will never find ways of bringing your? So first of all, let me explain you that just like market trades every day and market can move 2%, 5%, 10% every day, oil is pretty much a liquid market. And we have already seen that oil has moved like, 20, 30, $40 per day. So today, Brent trading at 100 doesn't mean that it cannot come down to 80. It cannot come down to 70 very fast. So that is first thing we need to understand. These are very, very liquid markets. Second thing is that there is like immense amount of supply, which was expected to come online. Of course, it cannot come online in 6 months or 1 year, but what happens is that if you have, there's a futures market, which is again very liquid. So if you have this continuous high prices of oil for 6 months, like for 2 or 3 months, all the 6 months. Right now, if you see all the future oil futures price of July or September or December are much lower than the current price of Brent, because producers are locking in that whole curve of their sales prices at very high prices. They never expected oil to be at 80. Forget about 100. um, 80 at 80, lot of oil in the world becomes very, very profitable. Right now it's a logistics issue, and we have seen what happens in logistics. Right now it's a Strait of Hormuz issue. It's not a fundamental issue of what happens with oil production and the economics of oil. And we have seen what happened when the COVID lockdown actually had a supply chain issues for very, very long time. So market has already got the worst played out in COVID, where supply chain was dropped, and that was the whole world almost. Like there was lockdown in Chinese port, there was a lot of lockdown everywhere, and it was a huge worldwide uh, supply chain impact. Right, rather than right now, we are talking about only 20% of the world's energy supplies, which is impacted. Even out of that, 4 to 5 million barrel per day is already routed by Saudi Arabia through East-West pipeline. So out of the 20%, a big chunk, I would say around 20 to 30% of the impacted quantity is already found a different route. And markets are very efficient. Like if you remember, year after year, all the other countries have reduced their production um, just to keep the oil prices high. So long term, oil has no issue. Oil economy is pretty stable. US producers can increase their supplies. A lot of other producers which have no impact of Strait of Hormuz can increase their supplies. So I don't think market is seeing it that way, and that is exactly the reason why the oil prices are not going up, because the futures market is controlling it. Because actual producers, they can always sell futures, and they can deliver oil. Means if you don't understand the oil market, if you can go to, there's a place in Oklahoma where you can be a short on oil, and you can actually take a barrel of oil which you have stored for a long time, and you can just deliver it there for a certain grade, and you can settle your futures there. So oil producers can do it. Of course, it's not logistically easy, but at certain price, it becomes easy, right? Means the cost of transportation to that place to settle, and even the long people who are long on futures, they don't want oil, they don't want barrels of oil sitting in their backyard, so they also have to exit. So oil prices are, these are paper traded oil. This is not going to stay forever if there are long term solutions found. So I'm not too worried about that. It's a short term problem. I'm not suggesting that um, it is not a short term problem. It is of a very, very consequential for a lot of Asian countries who don't have storages, who need to buy at the current price. Uh, there is a lot of second order effects of oil prices being high, which is the everything becomes more expensive for the cost of doing business. It's almost like a rate increase. Oil price being high is almost like a rate increase or a cost of basic inputs being higher for a lot of industries. So I think the biggest concern is a sustained inflation because of what happens with the Asian economy. And I think again, for good or bad, most of the economies, I think China is the biggest exporter, and China being the biggest exporter, and China having access to alternate routes, because they have uh, done very actively. They have diversified their sources. They are already, like they are able to get a lot of cheaper Russian oil. They are able to get a lot of other countries, and of course that's the whole geopolitics of it. I would say that that is another positive right now in this scenario for US. I mean, it's ironic, but there is a theory that US is going after every Chinese source of oil, whether it's Venezuela, whether it's Iran, and so on. On the other hand, right now, just to contain its own fallouts of the war, US wants China to have cheaper oil. So it's a very, very ironic situation from a long-term versus short-term perspective. So it's pretty much a solvable issue, I would say. And as I said, right, means ultimately, if you see the earning growth, like we had high inflation in 2022, we had a high interest rates in 2022, and we had one of the biggest, innovation of AI and investment growth which happened in the tech world, which is driving the world today. Um, can it slow down a little bit? Yes, if the inflation is high, interest rates are high, it can have some negative effect, but will it slow down so much that the S&P has to drop another 20% from here or 10% from here? that's debatable, right? Means the earnings are not going to come down, the AI is not going to slow down. Uh, we are not seeing that level of impact yet, right? So the cost of oil is just one factor, probably another 1 or 2% point on inflation. That is the worst case I'm talking about if the oil does not come down. And market is pretty quick in pricing that out, and that's what is happening right now. The market is pricing that out as we are seeing the drop, because if you look at the PE ratio of some of the tech companies right now, they are, we were discussing in our all access product also, some of these software companies, they are at a valuation of a 2008 level, right? Which is after the great financial crisis. Some of these software companies are trading at, at those levels of depression in terms of their, not in terms of their own earnings potential, but in terms of their valuations. So it's a very interesting dynamics right now. It's driven by panic. It's driven by a very short term scenario, which is solvable, even if this war rages on for years, I would say, which is very highly unlikely, because politically, my personal belief is that means Trump has always fought on no wars, and he's now got into a big mess with his own war being stretching out. So there has to be a solution. But irrespective of that, what I'm saying is the worst case is, means my personal belief is that this cannot go on. And even if it goes on, the market finds a bottom. Always, market always prices in ahead of time. So what you're seeing in last 2 weeks is market was overconfident about, as we always funnily call it or whatever. The market has this whole meme around the taco trade. Market basically got overconfident. Market bought the dip, and now right now this is the bought the dip guys realizing that they made a mistake. And once they get flushed out, um, the valuations are there. I think the market is getting very cheap every day if you look at the fundamentals. So that's where I think there will always be bunch will come in, and market. To be frank, all these discussions which they are having in the news media about inflation, about war continuing to drag, all those things, even if you price that in of the actual impact on earnings, my belief is that what we have already seen, and probably another 2%, 3% drop can happen, all of that is already priced in. And we can always debate around it. Means, of course, we cannot do it in this call, but we can talk through this. But I don't think that fundamentally anything changes. It's a momentum issue. It's as we call it, there is a lot of paper trading happening. There's a lot of leverage traders, and when you are being so used to a V-shaped recovery, there is always a time when it doesn't work. And what we are seeing right now, last 2 weeks is, and especially this week when the volatility is higher, is very clear loss of control from market makers, loss of control from those traders. Because once the volatility goes high, that means they are not able to contain market within a certain boundaries which they had defined, and they get liquidated. And liquidations always work like that, and that shows up in the VIX, that shows up in so much other data. And we also shared, I think we have been sharing in the macro channel,
Okay,
some of our analysts, the bankers who are sharing the institutional selling and the CTA selling, the momentum selling.
just one
Last
second.
week was one of the worst. All right, so let me take a quick question. Is selling option in such a political volatile scenario similar to picking pennies in front of road roller? Um, I would say it's opposite of it. In fact, so this is exactly what I was actually trying to explain when I said VIX is. So picking pennies in terms of for road roller will be a situation where market was not pricing in, and the option prices were very low, assuming the normal VIX of 16, 17, and the real war broke out. That's when you actually picked pennies and the market realized volatility was higher. On the other hand, currently selling options is in your favor because market is pricing in a kind of a disastrous situation of 2% move per day. So I would say we are in a exactly opposite scenario right now, especially if you look at today's volatility. If you look at many other scenarios like earlier this week, and as I was explaining at the start of the call, we have already seen every Monday in last 2 weeks, or Monday, Tuesday, Wednesday, when market decides, market actually reduces, the volatility comes down, crashing down, even though the market is not going up. So all this, we call it as a VIX compression. As an option seller, you are always benefiting in those scenarios. So I definitely would not call it picking pennies. I would actually call it like this is the best time to be an option seller. This is the best time where option selling strategies make the most money. Uh, Definitely at 2 to 3x level of the usual times. So if you're an option seller, if you're part of some of our strategies in Proflex, we call it as the best time to make money is now, when market is actually pricing in the worst, which is mathematically impossible. Mathematically, it's impossible to have a 2% per day move for a year, and that will basically make it zero. S&P 500 will be zero. Um, and if it go up and down, and if you're playing both sides, you're gonna make a lot more money at this time. So I would say this is actually be the perfect time if you are into options and if you know how to control the risks. So let me tell you, means again, we do promote this, we also tell people that be very careful how you do it, because it's not going to be fun ride if you don't know your option structure, you don't know the corner cases, you don't know how to manage risk. But I think my view is that uh, this is kind of the best time to be the option seller, especially because market is pricing in a worse than the worst case. Means as I can argue that 2% per day is almost theoretically impossible, which market is pricing in right now. No, but I think it's a good question because sometimes it can get a little confusing. And it's very technical, it's very mathematical in nature, that how this system works. And you cannot predict it, right? You cannot predict that today the VIX will be to 32, or tomorrow it will be 20. So what we always say is that you market, like structural money making and predictable money making, happens when you are having a plan and you adjust to the plan. People who try to predict and say that I know what will happen tomorrow, that's where I think you can get right once, twice, or three times, but market has a way to come back at you, right? Means market has a way to prove you wrong. So if you are especially doing leverage strategies, um, I always recommend that as long as you have a plan and you know the math around it, you know the risks around it, and that's exactly what we recommend and we make a plan for. So don't think of it as a, you know, like don't try to gamble away these things. Like if you're whether you're in all access or in managed account, we are always talking, we are always educating people on leaving. Actually, it's exactly the opposite. I say that you leave the pennies. We don't try to pick pennies in a market by guessing, right? Means make a plan. And as I said, we have done this before multiple times. We have done this, last year in April. We have done it in the growth. These are the times when, if you have a good plan, this pays you best. And the difference, which I always keep telling people, is when you buy stock, if you buy at a certain point, you have no other option but to wait for the stock to come back at the same level. In options market, the benefit which you get is that you can actually be profitable even if there's a little bit of recovery versus the whole recovery, because you are basically getting time value, you are getting rollover benefits, you are getting both. Like if you are hedging both sides, you are getting hedging profits. So there are so many different benefits of doing a structured option trade versus a stock only. On the other hand, because it's leveraged, and if you don't know how to build that structure, and if you are relying on oh, tomorrow it will come back, and it's a prediction based rather than a process based, then yes, it feels like you're getting in front of a road roller, and you can get liquidated with more than 100% losses. So it's a kind of a fine balance. I don't want to be to sell this in the sense that I don't want to convince somebody to do options if you don't understand it. But there are huge benefits of being the seller of options in this market. And I think a lot of people in this community do it. I think I'm not suggesting only Proflex. I know quite a few people here who do it even outside Proflex, and we have some good friends here who are in this call. So don't want to name them unless they want to come forward. But I think options has been one of the very useful strategies in a high volatility environment. All right, but these are good questions, I would say. Uh, So let me see. The next question here is in the chat is, if a stock that is in part of S&P is not falling even in this market, does it mean that it will go up much higher? Uh, I would say this is not a proven thing. There are two reasons for it. One is that sometimes a lot of advisors, like I'm sure, means you have worked with institutional advisors, means I don't believe in that, but a lot of what they do is when the market becomes uncertain and volatile, they just say, oh, these are safe sectors. They can tell you to go to utilities, they can tell you to go to some, old economy companies. And because of that rotation, which this, because nowadays the advisor-based businesses and advisor-based portfolios are huge, right? Means US has a huge retail population which is using your standard advisors, and they end up rotating out of the high beta to low beta, as they call it. That's the standard terms which they use in this model. So yes, market is highly volatile, and you might see some of these low beta stocks actually being, not falling at all, even doing better. Not because they are fundamentally better, just because people are rotating into them, just to save the kind of a beta, save the multiples. Um, I would say when market recovers, they may actually lose out. They may, because people will start chasing the high beta stocks again. So that is one theory, means which I'm just giving you a hypothetical scenario. I'm not suggesting that it's a rule. Just like you are saying that if they are not falling right now means they are stronger stock. I don't think it's a fundamental driven always. There's a lot of things which happen based on money flow driven, especially in the current environment, where there's a panic. People take, unfortunately, people will be exiting tech stocks at the bottom. This happens all the time. Last year we have seen it. We have heard so many stories of people exiting Nvidia at $90 because of DeepSeek. We have heard people exiting like 3 years ago when the Meta fell to $100 at one point, or Tesla when it fell to $120. A lot of people exited those stocks because their advisors told them that, you know what, there is no bottom for these stocks, they can go to zero. The story means they are too risky, they have dropped too much. So this is exactly what is happening right now. Right now, even if the stocks are great and there is nothing changing, there's a panic. And this is normal, right? Because there's a lot of passive investment. There is a lot of momentum investment. You see all the ETFs, they only, like, there are Mag 7 ETFs, there are so many. So when there is a panic and liquidations, unfortunately, even the stronger stock will suffer. That doesn't mean that, means I can guarantee you when the market reverses that stocks like Nvidia and Avago will be the first one to be leading it, because has anything changed for them? Like, means again, I'm not recommending to buy them. Means again, they can fall more because if the market falls, they have a higher beta, they have a higher exposure, they have a higher active exposure, which is not in the proportion of the index, because more and more active people invest in them, so risk is higher. But on the other hand, they also get recover fastest, and they, because the fundamentals probably work for them. So yeah, no, I don't think I agree with this theory. Yes, some of them might be seeing some buying on a case to case basis because they have some story going on right now, and people are rotating into it because of fundamental reasons. But sometimes it is not fundamental, sometimes it is just rotation into something we call it as a, safe stocks. And those safe stocks are, means very traditional, because I even had a, like, we talk to high net worth individuals all the time, and they tell us the stories of their advisor, the traditional advisor, what they tell them. And I've heard the people stories around, oh, don't worry about it, put it in, Home Depot or a Costco, or some random stock they pick up, and they say that these are safe, they don't move as much. And sometimes in these environments, because of that rotation, they start outperforming. That doesn't mean that they are fundamentally better stocks right now. Yes. So any other questions, guys? Let me know. But yeah, these are good questions. I think these are natural questions which come to your mind,
So, Rama,
especially in the current kind of drug. Yes,
Ish,
go ahead.
any thoughts on some of the news out there about potential nuclear action that might happen? What, how would the market react, and how has the market reacted
Mhm.
in the past when when we had the one event which actually ended the war? But
So
do we?
to be frank, this is going into too much of a speculation zone. I would, uh, first of all, yeah, definitely, if you're referring to a nuclear event, then first of all, it's a pure speculation right now. There are a lot of conspiracy theorists out there. I don't want to comment on that, but comparing anything from, something 70 years ago markets, even I actually hate when analysts start comparing this with 20-year ago market or a 40-year ago market. People start talking about 1970s oil embargoes and how the oil market behaved at that time, or how we can go to $250 because of that, versus now. I say that, first of all, never compare history, because structurally markets have changed every time for many different reasons. I identified to, like, 1980s was a very big change in US markets after that old time oil embargoes and all the impact, because passive investment started first time. The regular paychecks going every week, every 2 weeks basically into stock market started in 1980s. Then 2008 is a big turning point. Since then, like, this whole monetary policy, the money, the way the money supplies work, and the way there is too much money in the market always, that changed the market. So anything you compare historically, first of all, means I'm answering in a bigger picture. I'm not trying to answer this conspiracy theory, because yes, anything can happen. It's a war. People can go crazy at any point. Like, there are a lot of volatile elements here on both sides. I don't want to speculate on that, because 90% of them are conspiracy theories. But what I'm trying to highlight is you cannot predict those. Those are actual black swans. And right now, market is pricing in a lot of worst cases, probably because of these kind of conspiracy theories. That's why the Friday volatility is high. That's why we saw worse than usual fall today. And every weekend it doesn't happen. It's a positive for the market. I look at the positive side. Every weekend nothing worse happens. Monday will be a relief. Um, so I think it's mostly a 60-hour insurance premium increasing, and hedges increasing. That's what happened today. And we can see it in the data. We can see it in VIX. We can see it in option, open interests. We can see everything. Like, this data is very much available. So I can clearly see that it's a fear like this which is driving the market. Probability of these things happening, nobody can calculate, because these are, like, one of things, conspiracy theories. So there is no point of talking about it unless we actually face that. Means there are hundreds of things which can happen in the market which you cannot predict. I mean, whether it was COVID, whether it was, these are real black swans, right? The way things happen, and they blow up too much. Um, to be frank, this is coming like a black swan right now. Like, already we are reacting like a black swan, that this war was supposed to end into 3 weeks or 4 weeks, and we are still here. We are still looking at boots on ground. We are still looking at probably expansion of the war. So this is already turning out to be a black swan event, from a economy perspective. So can it be much worse? Of course, it can be much worse. But are we, have we not seen it? I think market is pricing in a lot of negatives already. So I'm not too worried about that. Um, then I see another question. How will you know that it is a good time to buy in this market again? So my view is very simple in this, right? Means long term, everything goes up, money supply goes up, good assets always go up, things settle down. So all the time is good. If you were a buyer at 7,000 S&P 500, you should be a buyer at 6,400 S&P 500. Of course, you should have ability to invest. You should have cash sitting there. You should, but yeah, means just manage the risk. Just make sure that you understand what you're investing. What if there is another 5% drop? What if there is another 10% drop? As long as you analyze those, I always say that it's always a good time to buy. It's never a bad time to buy, because long-term assets go up, good quality assets go up. The second thing is about risk management. And as I said, like, we are almost like 8 to 9% on S&P 500 and 12% on Nasdaq from the top. So definitely a good time, I would say. And by the way, I was reading one data that this whole 5% in a week kind of a drop is very unique. Those are 5 weeks in a row. If you look statistically, we are sitting at a almost 2 to 3 sigma event. Statistically, we are looking at always good outcomes in long run after this kind of a drop. But again, those are statistics, right? You can be 90% true, and this case might be the new history being made, right? So nobody knows. But what I'm saying is, odds are, on a longer term basis, odds are in your favor when you buy after the drop. So if you have the ability, means it's never a bad idea, as long as you're not leveraging too much, as long as you'll that you can absorb more pain in as the market goes down. And maybe I did not answer your question. How would you know? I would never know. Means, that's the whole point. This is exactly the reason why we always say you have to stay invested. Means if you miss out on those 2 or 3 good days, you will never be able to catch back on that, right? Means if you say, let me buy after market is stable, means if market is already stable and comfortable, most of the recovery is already behind you. We are already probably sitting at 6,800 S&P 500. If market is comfortable, means market tries to price in and runs forward always. So remember that it's not going to tell you that, oh, war is over and Strait of Hormuz has hundreds of ships going around, and by the time that news comes out, market will be at 7,000. I can promise you. It's not going to be something you will be comfortable with, and that's the part of being an investor. Like, you have to live through those tough periods. Means whether, and it's not something which you don't have to research or something, right? You can go back to COVID lockdowns. I still remember, like, immediately when the US locked down, within a couple of days, market bottomed. Go look at the Ukraine-Russia war. Within a week or 2 weeks, it had happened. If you look at the interest rate curve, before the first or second rate hike were in when they communicated, after that, rates kept on going up, but the market had already priced that in a very few weeks, I would say. So all these things are already happening in terms of uh, what is like, it's market front runs. That's what I can say. Right. Any other question, guys? I think I'll try to wrap up. It has been a long week, I think, for everybody. And let me take a quick question. So there's a technical question around what's the difference between marginable and non-marginable cash amounts in Charles Schwab. From anywhere, it's basically, there are some restrictions on what can be marginable or not. So what that means is, if that cash is not cleared or something, or it is blocked for some existing position, then that cash is not marginable. That's my understanding. But again, uh, I don't know exactly what is the context here. So that's what I cannot comment. All right, maybe a quick last question, guys, and then we can call it a day. But great discussions today. And as I think the summary today is very simple, right? That it feels the worst when the market is near the bottom. And I think today, again, I'm not suggesting it's the worst, but the VIX is still telling us a story. And that story is that market is pricing in one of the worst coming days. Um, so probably it can only get better. Means maybe we are 80% there, if not 100% there, in terms of what the market is telling us, because there is no surprise. This war has been there for last 4 or 5 weeks. Yes, it can get worse, and that is what market is pricing in already. Now it can get worse than the worst of what the market is pricing, as I think Ritesh or something, we were talking about earlier, that nuclear or this and that. Yes, the corner cases are there. Means anything can happen. This is the crazy world we live in today. But it doesn't mean that means the odds are in our favor. That's all I can say. Especially with the VIX, especially the fear factor, especially the market drop already behind us. So that's all I can say. Means the positive thing to take from here is, don't worry about, don't get into the fear of the market way up on you. Think little bit zoomed out. One way to do that is just look at the weekly chart, as I did. I did not go into a daily chart today. I did not go into anything else, because I just want to show people that once you look at those things, take a big breath, and think about bigger picture plans. That if you were told 3 months ago or 6 months ago that you would get a stocks at a 30% discount to their price in tech world, and S&P 500 at 10% down, would you not have thought about, oh wow, I would take it with both hands? On the other hand, also plan out what happens. So don't go over leverage in this market. Volatility can get worse. It can liquidate you. Understand your risk management. That's all I can say. So think positive, make a plan, think big picture. If you don't need the cash, great time to be an investor. I would say these are discounts you're getting, and try to see if you can make the best of it. So with that message, let's call it a day and have a great weekend.